Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a very important feature that's built into your OptionsPlay platform that is designed for just about any type of options trader who is looking to improve or learn how to trade specific option strategies, which is our paper trading and portfolio tracking feature. This allows you to take a strategy that perhaps you're learning for the first time or you're trying to improve your odds of success, and you want to test out a specific trade on a real symbol using real prices, but do so in a way without risking your real money. And allowing you to track that trade over time is how traders go about learning, analyzing, and improving their overall strategy. So today, what I want to do is walk you through a few examples of how to utilize our paper trading feature so that you can take trades that you want to test, if you will, practice trading them, track them in a portfolio, and see how they're doing. So we're going to do all of these things, and at the end of today, I'll provide you with a link that will have all of the trades that we talked about here today so that you can track them over time. And we're going to come back 4 weeks from today and we're going to review them here together. So I'm really excited to get started with this. But before we do, what we're going to discuss and the trades we're going to analyze here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of these specific securities that we're going to review on today's session. So we're going to start off with just a basic strategy review. We're going to talk about the high-level strategies that we're going to implement using paper trading so that you just have a brief overview of the strategies, how to implement them, and how to manage them, just so you have a reference point as to how do you find these strategies, and once you're in those strategies, when do you decide when it's time to cut your losses or take profits or simply exit the trade. We'll look at both bullish and bearish ideas as examples here today. And most importantly, what we're going to do is we're going to take those bullish and bearish ideas and we're going to paper trade them using OptionsPlay. I'm going to show you how to use the paper trading feature built into the platform. And then we're going to talk a little bit about the portfolio management. So once you're in these trades, how do you determine when it's time to take profits, when it's time to cut losses? And then what we're going to do is we're going to come back 4 weeks from today on August 18th, and we're going to review these positions here together. But like I said, I'm going to leave you with today's session with a link that will have all of the trades that we're going to go through here today so that you can track them on your own over the next 4 weeks. And then we're going to come back in 4 weeks' time and take a look at how each trade performed and give you a better understanding as to which trades worked out, which trades didn't, what are the benefits of certain strategies, what are the perhaps limitations of other strategies, and really discuss these things so that you have a better understanding as to how to use all these features. And then we'll open this up for Q&A here at the very end. But that's what we plan on going over. And the primary question that I want you to be able to walk away from today's session is an understanding as to how can we improve our options trading strategies and our position management using the paper trading and portfolio features here within OptionsPlay. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to walk you through the paper trading features so you know exactly how to use it and replicate it on your own for your own trading. So we're going to start off with just a quick strategy review of the different trades that we're going to paper trade here today, just so you at least at a high level understand what we're generally trying to do. So the first strategy we're going to look at is just simply buying a call option or a put option. These are two strategies that allow you to take a bullish or bearish view on an underlying stock. It's a very simple strategy, and the general rule of thumb for buying a call or a put is that we generally start about 60 days from an expiration date. So we usually go out about 60 days and we choose our expiration dates. And when we choose our strike prices, we usually try to choose strike prices that are close to the current price of the stock. And we're going to use delta to choose our strike prices. So about 50 to 55 deltas is usually where we want to start our research when we look at buying a call or a put. And I'm going to show you on our platform how you can find a 50 to 55 delta call or put. Now, these types of strategies have a fairly unique characteristic in the perspective that for a defined amount of risk that you take, you actually have unlimited potential reward. That is the convexity, if you will, that you receive from buying a call or put. You have fixed amount of risk. You have, in theory, unlimited amounts of potential reward if the trade goes in the direction that you expect it to. Now, this risk reward ratio for many investors seem very attractive, and it very well is. But there is a downside to the strategy, and it's the fact that you generally have a fairly lower probability of profit. Only about 35% of these trades will be winners. Largely 70% of these trades will be losers. But when you do win, you tend to potentially win fairly large, but you win fairly small percentage of the time. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of ones. So this is a simple strategy. We're going to go over a few of these here today just to make sure you understand them. This is one of the simplest strategies. The second strategy we're going to look at here today is a debit spread. A debit spread is very similar to a long call option, but we're going to improve the odds of success a little. So a debit spread, we're also going to go out 60 days to expiration. And we're also going to buy that at the money call or put, about a 50 delta, depending on whether we're having a bullish or bearish view. We'll select calls or puts. And then what we're going to do is, instead of just buying a call option and buying unlimited potential reward, usually within 60 days, we have a pretty good sense for how far a stock can go. Meaning, if we're bullish, we don't think the stock is going to go from 200 crowns to 10,000 crowns, right? Maybe over the next 60 days, we think it'll go from 200 to 250 crowns. Or for bearish, maybe we think it'll go from 200 crowns to 150 crowns. We don't think it's going to go to 0. So why should we pay for all of that? And this is really where options provide you with a lot of flexibility. What you can do is you can sell an out of the money call or a put against that. And by selling that out of the money call or put against the long call or put that you've purchased, you usually can save about 20% of the long legs premium or collect 20% of the long legs premium, and that's going to help reduce your risk on the overall trade. It's going to reduce your risk, and it's going to improve your odds of success. It doesn't improve it by a ton, but it certainly puts the odds better in your favor. We tend to find closer to 37 to 40% winners in this particular case. So you're going to have fewer losers, more winners. But the trade-off here is that now, for every 100 crowns you risk, you're going to have a limited amount of reward. But that risk-to-reward ratio is still going to be positive, meaning whatever you risk, your potential reward is still likely going to be close to double that, sometimes triple that, depending on the debit spread that you're trading. But the risk to reward is skewed in your favor, and you have a higher probability of success. Does that make sense? Or higher probability of success compared to the call option? If that makes sense, please type 2 into the chat window. Perfect. Okay, I see quite a few 2s coming in. So the third strategy we're going to discuss here today is a credit spread. This is quite different from the first 2 strategies. This is a more neutral, more mild strategy. We're going to see how the first 2 strategies, the call option and the debit spread, it's suitable when you have a strong directional view, but not every single time you want to trade something do you have a strong directional view. Sometimes you just think the stock has a loose directional view, a mild directional view, and that's really where credit spreads come in. So for a credit spread, the optimal credit spread is going out only about 45 days. And what you're doing is you're selling the at the money call or put. In the previous 2 examples, you were buying the at the money call or put. Here, we're selling the at the money call or put, and we're reversing it. If we're bullish, we're selling the put. If we're bearish, we're selling the call option. And then because selling just a call or a put, number 1, you need to have a lot of capital to do so. And number 2, you take on a substantial amount of risk if you just sell a call or just sell a put. So what we do here in the spread terms is we buy back a out of the money call or a put. And this does 2 things. Number 1, it reduces the amount of risk that we have to take on the overall trade, and it significantly reduces the amount of capital that we need in order to execute the trade. So it has both benefits. And the rule of thumb here with credit spreads is that, generally speaking, you want to collect roughly 1/3 of the distance between 2 strikes. What that means is that if, let's say, I sell a 100 strike put and then I buy back a 90 strike put, the distance between these 2 strikes is 10 crowns, right? So what I want to collect is 1/3 of this. 1/3 of this is about 3.33 crowns. So if I'm selling a 10 crown, the distance between these two strikes is 10 crowns. If I select a 10 crown put spread, what I want to collect is about 1/3 of that, 3.33 crowns. And when you do something like this is where you have a much higher probability of success. In the other few examples, you had 30–40% chance of winning. Here, you typically have closer to 60–70% chance of winning, which certainly sounds great, right? Who doesn't want to win more often? Why would you ever want to win 30–40% of the time when you can win 60–70% of the time? Well, there's a catch to it. The credit spreads have a negative risk-reward ratio, which means that for every so here, for every 100 crowns in potential reward, you are actually taking on roughly double the amount of risk. So that's the catch, if you will, to win more often, is that you can win more often, but when you lose significantly larger than what you win. So that's the catch that you generally have when it comes to selling these types of credit spreads. But does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. And if this doesn't make sense, I'll show you how to access further education to learn more about these individual strategies. This is just a review. This is not a full comprehensive review of these. This is not a deep dive into these strategies. If you want to learn more, I'll show you how to access that education. But today's just a review, and then we're going to go through some real examples. So when it comes to managing these trades, so the first 3 slides that we just went over are showing you how to get into this trade. But a lot of questions that we get from investors, and a lot of the work that investors that you need to learn, is how to manage these trades. And that's really where the rules are a little different depending on the trades that you make. So the first part, long calls and puts, this is the first strategy went over, and debit spreads. The rules for managing both of these are exactly the same. So the rules are fairly simple and they're easy to understand. Basically, there are 2 possible triggers to exit a long call or a debit spread. And whichever one triggers first, that is your signal to get out of the trade. You either exit the trade when you've lost 50% of the premium that you've paid to enter the trade, or you take profits when you've reached about 75–100% of the premium that you have paid for the trade. So let's say you buy a call option or you buy a debit spread and you pay 3 crowns to get into that trade. What that means is that if you pay 3 crowns for something, and the value of that option that you've purchased, or the value of the spread that you purchased, declines down to $1.50. It declines down to 1.5 crowns. So you buy something for 3 crowns, it declines to 1.5 crowns. You've lost 50% of what you've paid. It's time to exit this trade and get out at a loss. You don't want to continue holding on to this trade, because at that point, your chances of gaining your investment back and making a profit on it is relatively small. You have a very high probability that you're just going to lose the other half of the trade. So it's best to simply cut your losses and move on to the next trade. Now, if you pay 3 crowns for something, and the value of that option or value of that spread increases in value to 5.25 or to 6 crowns, somewhere in this range, then you've made 75–100% gain on your investment, if you will. And that's when it's time to start taking profits and getting yourself out of the trade here as well. So that's really how you want to utilize long calls and long debit spreads, when you want to get in and when you want to get out. The rules, again, for call options and debit spreads are fairly simple. You have a stop loss target and you have a take profit target. Whichever one hits first, that's your rule to exit the trade. So fairly straightforward. But when it comes to credit spreads, it just gets a little bit more complex, because for credit spreads, there are 3 possible triggers to exit this trade. You have a take profit, you have a stop loss, and then you also have a time-based signal, because if the stock reaches 50% of the max gain, it's time to take profits. I'm sorry, if you've gained 50% of the max gain, it's time to take profits. If you lost 100% of the max gain, it's time to cut losses. Or if the trade gets to 21 days to expiration and it does not trigger your stop loss or your take profits, it's also a signal to get out of the trade. So just to give you an example here, let's say you sell a $5 crown wide credit spread and you collect 2 crowns for it, right? So roughly we try to collect 1/3 of the width. Here we're collecting roughly 40% of the width because 2 crowns out of 5 crowns is 40%. Here we're collecting 40 crowns. So if you sell something for 2 crowns, and the value of it decreases to 1 crown, that means you've made 50% of the total max gain that you could potentially make. Because if you sell something for 2 crowns and it goes down to 0, you've made 100% of the max gain. So when you make half of it at 1 crown, that's a good time to take your profits and move on to the next trade. Now, if let's say you sell something for 2 crowns and it starts to go in the opposite direction, it starts to increase in value to, let's say, 4 crowns. Now, what you've done is you've sold something for 2, and if you have to buy it back for 4, you've lost 2 crowns, which is 100% of the max gain. That's a time to start cutting your losses. So when you place an order to sell something for 2 crowns, you want to take profits at 1 crown, which is 50% of the max gain. And then you want to set a stop loss at 4 crowns, which is 100% of the max gain on that particular trade. But if the trade gets to 21 days to expiration without triggering your stop loss or your take profits, it's also time to cut this particular trade. It doesn't matter whether you're making money or losing money on the trade. Once you get to 21 days expiration, you should get out of the trade. And this is all to avoid early assignment. This is to avoid potentially having the short leg of the trade being assigned early. To avoid that, you can use this 21-day rule. That's roughly going to keep you out of trouble from early assignment. So those are the rules for trading calls and debit spreads, simpler two-part rule, and credit spreads, a little bit more complex 3-part rule. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's look at some paper trading examples using OptionsPlay. Let's show you how to apply these things using the OptionsPlay platform. So the first trade I'll look at here is BILL. Now, I'm going to use, these are trades that are randomly selected. These are not I'm not recommending you trade these. I'm just using them as examples, so be very clear. When I refer to 21 days, Jonas, I'm referring to 21 calendar days, not business days. So 21 actual days on the calendar. So basically 3 weeks from expiration. So these trades that we're going to look at here today are purely for example purposes. These are not recommendations or suggestions that you should trade them. So the first one I want to take a look at is BILL, because recently it just broke out here above a all-time high of 177, 178. Recently today, big move here to the upside. Maybe we're looking for this to continue. So we'll look at a few different trades that we can make here for BILL. We'll look at buying a call option. We'll look at a debit spread, and maybe we'll look at a credit spread if we can find an appropriate one. So first, I'm going to go out to, let's look at just the call option here. So remember how I was saying that you want to buy roughly a 60-day 50-55 delta call option. Well, the September 17th is 58 days to expiration. So that's why I'm going to select the September 17th expiration. And then as you can see, I have 3 numbers on the strike prices. I have the strike price, I have the premium, and then I have the deltas. So the 185s is a 42 delta. The 180s is a 57 delta. 57 is the closest to the target deltas that I want, 50 to 55. So that's why I'm going to select the September 180 call option. That's currently trading at about 6.4 crowns or 640 crowns for the contracts. So this is an example of a call option, a simple strategy that I could potentially trade on this particular stock. So this is a simple call option. So how to paper trade this this particular trade? What you do is any trade that you want to paper trade, you click on the blue share button on that specific strategy. So the September 180 calls, I'll click on the blue share button. Once I click on that, you want to click on the save button here on the right-hand side, okay? When you click on the save button, what it does is it saves this trade and it starts tracking this trade in your portfolio. Once you click on the trade button, you'll get 2 links. an image link, and a share link. You don't have to, you can copy this if you want, but it's actually automatically saved into your profile, okay? So let me just review this. You click on the blue share button on any strategy that you want to place, and then you click on the save button here on the right-hand side. Once you do that, it's gonna save the trade in your profile. Now, how do you go and find your old trades? You go into your profile, which is right here on the upper right-hand corner. You can click on your name in the upper right-hand corner, click on profile, and then they're all going to be in the shared trade section here. So all your trades are here. So the one that I just created here on BILL, that's right here. So I can tell you that I bought one contract of the September 180 calls. And you can always click on this link here to revisit the trades that you want, either the share link or the image itself. I always use the share link because when I click on the share link, what it does is it brings me back to the page. It has the strategy that I was looking at here before. And what it does is it tracks the position for you. It tracks the P&L. Now, right now, because I just created this trade, the stock hasn't moved at all. So the trade P&L here is 0. But if I go back into my profile and I look at a previous trade that I put on just a few weeks ago here, if I click on this one, this Embracer one, here I can look at a trade that I put on a few weeks ago. This was a bearish trade on Embracer. I had bought the 230-195 September 17th debit spread. It's currently trading at 1,465 crowns, and I've made 80 crowns on this particular trade. So this is how you can utilize the OptionsPlay tool to find a trade that you want to place, save it for a paper trading, and then come back to it later and see, is the strategy profitable? Is it losing money? How much am I up or down by? And decide, okay, is it time for me to stay in this trade or is it time for me to cut my losses? And then you can remain in this trade and continue to learn and tweak your strategies. And that's really why we created this, this tool, is to help you quickly find strategies, paper trade them, and come back and review them. So what I'm going to do is I'm actually going to save these links, and I'm going to share this with everyone so that afterwards you can review these on your own and paper trade them over the next 4 weeks before we come back for our next session. Okay, so I'm going to share a document with you here at the very end so that everyone has access to these reports afterwards. Okay, so let's go back to the app. Let's look at another trade for BILL. Instead of buying a call option here, why don't we look at maybe looking at a debit spread? Let's see if we can find a debit spread here. Let's go out to September 17th and let's buy the 180-195 debit spread. So instead of risking 640 crowns, I'm only risking 550 crowns. Those are the benefits potentially of this debit spread. So once again, I'm going to click on the blue share button. Then I'm going to click on the share button. And that's going to help me generate this link that I can use. And I'm going to copy this link for you guys so that you guys can, I'll send these links to you guys afterwards so that you can use these to track these over the next 4 weeks. And then you'll be able to use these to review on your own to see how each one of these strategies performed. And we'll come back 4 weeks later to look at them together. And let me just see if I can find a credit spread here for this as well. So like I said, credit spreads, we like to go about 45 days. Right now, I only have September or August. So let me go out to September for now. You know, we'd like to sell the at the money and buy the 25 deltas. So I'm selling the closest to the at the money, which is the 180 strike. And then if I want to buy back a 25 delta, the closest strike price of that is the 170. So if I sell the 180, 170 vertical spread, notice here, okay, here's an example. The distance between these two strikes is 10 crowns. But I'm only collecting 270 crowns out of a 10 crown wide credit spread. That means I'm only collecting 27% of the vertical width. So remember, when we looked at our credit spread trades, On the credit spreads, we said that we want to collect at least 1/3 of the distance, which is 33%, right? We want to collect a minimum of 33%. But in this particular example, we're only collecting 27%. So in this particular case, this is an example of a credit spread that you should not take because you're not collecting enough premium. Because when I collect 270 crowns, I have 730 crowns of risk. I'm risking almost 3 times my potential reward. That is not a very good risk reward ratio. That's why we have that 1/3 width, right? Because when I collect 33%, of the width, that means the other 67%, that's my risk. So I'm risking roughly double what I can potentially make. That's the worst risk reward ratio you should take. If you're collecting 27% of the width, that means you're risking 73% of the width, and that's a risk to reward ratio that is not working in your favor. So here is one that we're not going to sell a credit spread on. So we're just going to look at the long call, and we're going to look at the long call vertical. Okay, so I've saved those 2 trades. We're going to come back here in 4 weeks and look at them together. The next trade let's look at together is, let's say, Sandvik. Let's look at Sandvik, and Sandvik is interesting, right? Because it's currently just trading in this range. It's not significantly bullish, it's not significantly bearish, but it has recently bounced off the bottom end of this range. And recently, whenever it bounces off the bottom end of the range, it has a pretty strong move here to the upside. So maybe we're expecting the same, right? So that's the expectation that I'm currently looking at here for Sand. So let's see if we can first of all find a put credit spread, because we didn't find one here earlier. Let's look at the expirations. Oh, so this one, I'm even further limited in expirations. I either have August or I have October. So let's look at August. I'm not confident that I'm going to be able to find something, but let's try. So 220, 215s. This is okay. This is not terrible. Okay, this is a 5 crown wide credit spread. 220, 215, and I'm collecting 160 crowns out of a 5 crown wide credit spread. So that's roughly just about 33%. Technically 166 crowns would be 33%. So I'm just 6 crowns shy of 33%. So let's take a look at this. Why don't we save this particular trade? Okay, we're going to click on the share button here again and save. Let's review this. This expires just 2 days after our next session on August 28th. It's not ideal, but it is an example of one. So we'll save this here and we'll look at this again in a couple of weeks. So this is a short put vertical. So ones are, the one that we did before is a debit spread. And this one is going to be our first credit spread. We'll try to find a few more credit spreads to look at, perhaps ones that are a little bit more optimal. So we'll look at this one first. And then let's also look at another one. Let's look at trading a debit spread. Let's go out to October. October is the closest one that we can find to the 60-day expiration that we generally want. We're buying the 220 strike because it's the closest strike to the 50 to 55 deltas. This is 57 delta. And then we're going to sell the 245 strike because that is exactly 20 delta. That's the strike price that we want to sell on a debit spread. So this is exactly what we're looking for. Let's save this trade here as well. This is risking 930 crowns to try to make 1,570 crowns. So we'll save that one here as well. So this is Sand, where this is a long call vertical, which is a debit spread. So let's look at that. Another stock I wanted to take a look at here is LUNE, energy stock. Energy has been performing quite well here. This is a stock that has severely oversold here with crude pricing over the past few weeks or so. Maybe it's getting to a little bit of an overbought condition and we're looking for a bit of a bounce. This is actually, in my opinion, the ideal conditions for selling a put credit spread or selling a put credit spread. So let's see if I can possibly find one here. The 273, 250, 270, 275 maybe. Let's see. So that's 15 crowns wide, but I'm only collecting 470. Let's see. Here's a little better one, but let's also go out to September and see what we can get for September. Both of these are collecting just shy of 33%. Let's see. I'm going to try one last thing. Let's see. Okay, here's an interesting one. I'm doing slightly in the money because currently the stock is at 270. Let's just call it 274. So I'm going to sell the 275. Well, I'm going to consider that the at the money. And if I buy the 260s, which is the 32, so I can either do the 250s or the 260s. I'm going to do the 260s. That's a 32 delta, right? So that's close to the 25 delta. So as you can see, the distance between these two strikes is 15 crowns. And I'm collecting 5.9 crowns, which is a little over 33% of the width here. It's not the ideal strategy because I'm slightly in the money, but I'm only in the money by one crown, which is okay in my opinion on a 275 crown stock. So this is an example of a credit spread that we can trade. As you can see, I'm risking 910 crowns to try to make 590 crowns. That's the strategy here. So we're going to save this and we'll take a look at LUNE. The other strategy that I think might make sense for a stock like this is perhaps just outright buying a call option. And the reason for this is because looking at this particular stock, maybe this is what we're going to likely see, a very sharp move back to the upside. So perhaps a call option is also suitable here. So let's look at a September 270 call. So September is 58 days away, and then the 270s is 57 delta. So you can either choose the 270s or 275s. Let's do the 275s here. So this is risking 1,260 crowns. Let's say this particular trade for us to review. And then, maybe what I can do here is I'm going to also look at perhaps a bearish trade on this. What if, and I think it's always good to look at both, right? Maybe you might disagree with me. Maybe you think that oil prices is heading even lower, and you think a stock like this might actually continue to move lower. So let's just also look at maybe a bearish credit spread. Let's see if we can find a bearish credit spread. Let's go out to September. Let's sell the 275, 295. Let's see. Okay, here's a good one. A 20 crown wide credit spread, and I'm collecting 760 crowns. So this is a credit spread, but this is a bearish one, right? The stock has clearly declined quite a bit here over the past couple of weeks. Past couple of days. Maybe you think that this can continue moving lower. So let's look at selling a put credit spread here. So we're going to look at a bullish trade on LUNE, but we're also going to look at a bearish trade on LUNE. So we'll do a short call vertical here, which is a credit spread. And then we'll save this particular trade, which is, if you click on the blue share button, we'll click on the save button. This will allow us to track this trade. So right now we have two bullish trades on Bill, two bullish trades on Sand. We have two bullish trades on LUNE. We have one bearish trade on LUNE. Let's round this out with maybe a couple of more bearish trades here. Let's look at JM. JM, this is a stock that was recently in a very strong uptrend, but after a couple of months, about a month ago, it broke this strong uptrend. It came back to retest these levels as resistance, and it has been rejected. And if you look at the trend quality, right, notice how down here you have very strong green trends, very clean green trends that started to deteriorate, and now it's just continuing to deteriorate. So maybe you think that this is a stock that is heading back lower. So here's an example of maybe taking a look at buying a put option. Going out to September, let's buy a put option here. Let's look at buying September 305 puts. This is the at the money puts. We'll save this link for everyone to review. This is a long put. And then we'll look at a few other put strategies here for JM. We'll also look at the debit spread. That is a popular strategy. So if I go out to September and I buy the 305 puts, that's a 49 delta, so about 50 deltas or so. I'm going to sell the 275s, which is 18 deltas. That's the closest to the 20 deltas. That's how I'm trading this 305 275 put spread, which risks 806 crowns to try to make almost triple that, 2,140 crowns. So we'll look at this one, JM, bearish, long put vertical, which is a debit spread. And then lastly, if I can find a credit spread on this, we'll do one last credit spread. So we'll modify this. We'll use our strategy constructor. We have a bearish view, and we're going to sell a call vertical. Let's see if we can find one. So again, I'm stuck between using September and August. So I'm going to go out to September. Let's see if I can sell the 305, which is the at the money strike. And then we're going to buy back, let's say the 320s, which is the 30 delta strike. That's the closest to that, right? So this, remember, this is a 15 crown wide spread because the distance between 320 and 305 is 15. So 1/3 of 15 is 500 crowns, but here I'm collecting 620 crowns. So I'm actually collecting far more than the potential minimum that I'm looking for. So here's a great one for us to take a look at. Let's save this trade here as well. And then we'll wrap this up so that you have quite a few different trades that we can review. Let's do JM, bearish, and then we'll do this short call vertical. Okay. So that wraps up all the trades that I want to make. And if you want to, you can always go to your profile, and go to your shared trades, which is right here on the right-hand side, and you'll see all the trades that we just posted together here in this particular, in this particular section, right? And you can, in your own profile, click on the share link, and that will reopen the trade that you previously put, and you'll be able to save these trades. So what I've done here for everyone on today's session is I've saved these trades into a Google Sheet, and I'm going to share this Google Sheet with everyone so that you can follow along. So the trades that I just made, I have included all of the links here for you so that you can follow along. Each one is a unique link, and all you have to do is click on the link and you'll be able to see the symbol, the bullish, whether it was a bullish or bearish trade, and what strategy we traded on each one. So I'm going to share the Google Sheet with everyone so that over the next 4 weeks, as you follow along, you're going to be able to utilize, you're going to be able to follow the trades that we looked at here today. We're going to come back and review them in 4 weeks. You're obviously free to put in your own paper trades with any of these strategies or any strategy that you want. You can paper trade and test them out and use this feature and use the portfolio feature that will allow you to look at your shared trades. So just as if you want to see this Google Sheet, you can go to trade.optionsplay.com/paper Nordic paper trade, which I'll post a link into the chat window. If you go to that link in the chat window, that will give you the Google Sheet that I just saved here. It has all of the trades that we reviewed today. It'll give you the symbol, whether it was bullish or bearish, what strategy we traded, as well as the paper trading link. So you don't have to wait for the 4-week session in 4 weeks to look at them. You can look at them every single day, see how different strategies perform. You know, each strategy has their pros and cons. Some of them have lower risk, some of them have higher risk, some of them have low probability of profit, others have high probability of profit. So hopefully today we did we have 4 different symbols. We have a few bullish views, a few bearish views, and hopefully this will give you enough diversity, if you will, to be able to see how these different trades are tracking, and it'll give you a better understanding as to how you might want to manage these trades. So over the next 4 weeks, if you see any of these trades perform very well or perform very poorly, you might say to yourself, oh, now is a good time to take profits, or now is a good time to cut my losses. You're going to have access to the recording of the session. You're going to have access to the slides of today's session if you want to review the rules for cutting losses and taking profits for each one of these trades. I should recommend that you do that. And over the next 4 weeks, come back every single week, look at some of these trades on these spreadsheets, and we'll look at them together here in 4 weeks' time. So with that, that covers what I wanted to share with you here today. The next session is on August 18th. So exactly 4 weeks from today on Wednesday at 5:30 p.m. Stockholm time. So with that, that covers what I wanted to share with you here today. What I will do is try to answer some questions here. If you have any questions, you can type them either into the Q&A section, or you can type it into the chat section, and I will try to answer as many questions as I have time for here today. Kamal asks, are we going to get this presentation later on? And the answer is yes. You get the recording, you get the slides, and now you have the spreadsheet that you can access the trades that we saved on today's session, which again, the link to that spreadsheet is on trade.optionsplay.com/Nordic paper trade, which I just posted into the chat window again. But I'll put it on the screen for those of you that want to write it down or save it somewhere else. How come you don't consider POP that much? Risk to reward of 33% much more important. So POP is looking at only 1/2 of the equation. That's why you never look at POP. If you look at POP, then you're only optimizing for one thing and you're completely missing the other half of the picture. So it's not that we don't use POP. We use the OptionsPlay score. The OptionsPlay score looks at both POP and risk to reward ratio. You know, what I tend to find that is a lot of investors spend too much time looking at POP. And what you notice here is that POP is simply just a factor of risk to reward. If you think call options have very low winners, that's true. But for every 100 crowns in potential risk you take, you have unlimited reward, right? So basically the lower POP gives you a much better risk to reward. On the flip side, if you look for high POP, right, like for example, credit spreads have high POP, but has very poor risk to reward. For every 100 crowns you can potentially make, you're risking 200 crowns. There's a relationship between POP and risk to reward. And what you're really looking for is a good balance between the two. Don't ever look at just one. If you look at one, then you're basically missing half the picture here. So that's why we use the OptionsPlay score. The OptionsPlay score accounts for both max reward, max risk, and POP, and it gives you a sense for whether how well balanced those two metrics are. Any other questions regarding the strategies, the paper trading? When to choose credit or debit vertical spreads? So great question. Hopefully in 4 weeks time, as we come back and we look at each one of these strategies and see how each strategy has performed, that's going to truly help you answer the question. But you know, the short answer is, if you think the stock's going to make a big move, you should buy a call or you should buy a debit spread. If you think the stock's going to make a really small, mild move, that's when you want to sell a credit spread. But I think once you actually watch all of these trades, and some of them are debit spreads and some of them are credit spreads, as you see the stocks move in your favor, as you see the stocks move against you, you're going to better understand when it's best to use the credit versus debit spread. Kamal is asking, would you please difference between EU style and US style options? So Kamal, everything that you're trading here are American style options. So European style options are options that cannot be exercised early. American style options can be exercised at any time prior to expiration. So all of the stock options that you can trade here in the Nordics are American style options. So you can exercise them at any time. So if you own a call option, you can exercise them at any time before expiration. That's the difference between European and American style options. So currently you cannot delete an old trade in the shared trades. All the trades will be there. They simply will not work after they expire, but you cannot delete old trades right now. Can various trades be color coded? So currently we don't have that. I don't know what you would want to color coded by. So if you have some thoughts on that, I'm happy to listen. Tommy is asking, do you plan on including Ivy rank and OptionsPlay? So we currently have Ivy rank here in the US. We don't have it for the Nordics yet, but we are, again, looking at data providers that can give us the data that we need to calculate Ivy rank here for the Nordics. And we have identified a vendor that can provide us with the data. So we are working on that. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding as to how you can utilize our paper trading and portfolio tracking features to help you better understand and track positions. I cannot stress enough, if you're new to trading, how important it is to paper trade at first. Don't risk your real capital just to learn and see how a strategy performs through the life of the strategy. A lot of investors have a thought and view as to what what it's going to be like, but once they're in the trade, things can be different. This actually allows you to see how a strategy performs as the stock goes in your favor or goes against you, so that you have a better understanding of risks and rewards. As you track these over the next 4 weeks, and we come back 4 weeks later and look at the results, that's going to help hopefully give you a better understanding as to these strategies. So I hope to see all of you there here in 4 weeks' time. Thank you so much and have a great trading day.